Alibaba gained $13 billion in value this week after billionaires co-founders Jack Ma and Joe Tsai demonstrated their confidence in the company's future outlook by buying $200 million worth of shares. The stock was up 10% this week and is down over 33% since January 2023. So, does this show of confidence mean that Alibaba is destined for a rebound, or will the stock continue to underperform in 2024? In this video, we will answer this question by analyzing the Alibaba stock, reviewing important financial metrics, comparing the stock's performance against competitors, and assessing the stock's dividend safety. By the end of the video, we will run the numbers through our valuation model, deciding on an acceptable buy price, considering the risks associated with the company, and I'll also share with you my strategy and what I've been doing with Alibaba in my own portfolio. Before commencing our analysis, I first want to welcome you all to Investopia, where we discuss everything finance. I also want to share a friendly disclaimer. Please remember that this is not financial or investment advice, and that you should always do your own due diligence and make decisions based on your own circumstances. With that being said, let's get right into it. Alibaba Group Holding Limited, or Alibaba, is a Chinese multinational technology company specializing in e-commerce, retail, internet, and technology. It provides technology infrastructure and marketing reach to help merchants, brands, retailers, and other businesses engage with their users and customers within China as well as internationally. The company operates through 7 segments, which make up the Alibaba ecosystem, as shown on the screen right now. These are China Commerce, International Commerce, which includes AliExpress and Alibaba.com, Local Consumer Services, Digital Media and Entertainment, Innovative Initiatives and others, Logistics, as well as Cloud, where Alibaba is the 4th largest cloud provider globally. At the time of filming this video, Alibaba is a mega cap company with a market cap of $188 billion. It is trading at a price to earnings ratio of 10.37 and has a dividend yield of 1.35%. Looking at the stock's performance over the last 5 years versus the S&P 500, we can see that Alibaba has significantly lagged the S&P, decreasing 56% since January 2019, while the S&P increased 80%. We would have to go back to 2020 and early 2021 to see Alibaba outperforming or even competing with the S&P 500. This is even more evident when we take a look at the history of Alibaba's market cap. We can see here that Alibaba was worth $838 billion at its peak in 2020. And at that time, it was destined to become the first Chinese trillion-dollar company. Today, the company is worth $188 billion, which means that Alibaba's total value decreased by a whopping 77.5% in 3 years and 3 months. Now, when comparing Alibaba's performance with its main competitors in the Asian continent, Pinduoduo, JD, Coupang, and Sea Limited over the last 5 years, we see somewhat mixed results. Pinduoduo and Sea Limited outperformed, increasing 390 and 158% respectively. JD is basically flat with a 3% decrease in its share price, while Coupang is the worst performer after Alibaba with a 70% decrease in its share price since 2019. Moving on to Alibaba's financial statements, and with such awful stock performance, you'd probably expect to see that reflected in their financial metrics as well. I mean, fundamentals must be crumbling to explain the stock's performance, right? Well, it's actually the exact opposite. Revenues grew from $48.4 billion in 2018 to $128.1 billion in the trailing 12 months. That's a CAGR, or an average annual growth rate, of 27%. Similarly, we see that net income increased from $9.8 billion in 2018 to $18.6 billion, which is a CAGR of 17.1%. However, unlike revenues which consistently increased year to year, net income's performance was a little bit less impressive, decreasing from 2019 throughout 2022 during the pandemic, but looks to be jumping back as of the trailing 12 months. Now, despite this inconsistency, Alibaba still almost doubled its bottom line in this 5-year period. So overall, it's amazing growth rates for both top and bottom lines since 2018. As for the balance sheet, we see that the cash balance in 2018 was $28.1 billion and increased to $80.4 billion in the trailing 12 months, which is a CAGR of 29.5%. Similarly, current assets, which also include the cash balance, increased from $36.7 billion to $106.2 billion, which is a CAGR of 29.9%. Net debt, which is the sum of short and long-term debt minus cash and cash equivalents, decreased from -$9 billion in 2018 to -$57.1 billion. That's an average decrease of 57.3% per year. you'll notice that it says that net debt increased, but that's a typo. It actually decreased 57.3% per year. Now, what does this all mean, and why is Alibaba's net debt negative? This basically means that Alibaba's cash balance is currently higher than all the company's debt combined. And given that net debt is total debt minus cash and cash equivalents, the result is a negative number. To clarify this further, let's take this number here, the 57.1 billion. This value means that Alibaba has enough cash on hand to pay off all the company's debt and will still have this $57.1 billion left over, which is truly remarkable. Now, in terms of the dividend, Alibaba just started paying a dividend. In fact, the first payment in the company's history was this month. So there's not enough data to generate the dividend safety score and other relevant metrics, but what we will do is review whatever data points available for us today. Starting with the payout ratios, Alibaba's earning payout ratio is currently 13%, which is much lower than our preferred 60% threshold. We generally want it to be less than 60% as it gives the company space to continue increasing the dividend in the future. And as you know, I personally prefer to use the free cash flow payout ratio as the earnings payout ratio can be subject to accounting manipulation. Again, anything under 60% is our preference, and as we can see here, Alibaba's free cash flow payout ratio is currently 11% and is expected to stay at that level in 2024. Shares outstanding have increased slightly from 2.3 billion shares in 2014 to 2.6 billion shares today. It's not a drastic increase in shares, but we generally want to see shares moving in the opposite direction, as it signifies that our ownership stake in the company is getting bigger and the company's profits are being distributed on less and less shareholders. One thing worth mentioning is that in 2022, Alibaba introduced a new share repurchase program, and early this month, it announced that the company had repurchased a total of 898 million shares worth $9.5 billion during 2023. These shares were bought in both the US and Hong Kong stock markets. The share repurchase program, which remains effective through March 2025, still has $11.7 billion remaining to be allocated for share buybacks. So going back to our chart, you can see that since 2022, the shares outstanding have been decreasing and are expected to continue to decrease until 2025. Demonstrating Alibaba's commitment to return value to its shareholders. Now, coming to Alibaba's return on equity and return on invested capital, and just in case you don't remember, a higher return on equity usually signifies a company's moat, while the return on invested capital reflects management's ability to effectively allocate and reinvest capital. Generally, we like to see a minimum of 10% for both metrics. However, the thresholds could change slightly depending on the industry. As you can see here, Alibaba's return on equity has generally been over our 10% threshold, except for 2022 and 2023, where it dropped to 4% and 6% respectively, but it looks to be recovering back to that level. As for return on invested capital, it has been hovering around the 10% level since 2015, coming a bit lower in recent years. It has averaged 11.5% since 2014, which is not bad, but I would like to see it surpass the 10% level moving forward. In terms of the operating and free cash flow margins, Alibaba's numbers are actually really good, especially relative to its industry. Despite the recent drops, the margins have averaged 24.2% and 33.3% respectively. Just for context, let's quickly compare these metrics with Amazon, which is considered Alibaba's US-based competitor. We can see that Amazon's operating and free cash flow margins average 3.1% and 3.9% respectively, which is miles away from Alibaba's levels. As for net debt to EBITDA, net debt to capital, and interest coverage, there's nothing really to show. Alibaba has virtually no debt. As we saw earlier, if they wanted, the company can pay off all the debt owed with the cash on hand and still have 57 billion of cash left over, which is remarkable. So in summary, although the company has just started paying a dividend, with this balance sheet, the dividend is as safe as it gets. Jumping into our valuation models, we'll be reviewing 4 distinct models to get to our intrinsic value and acceptable buy price. If you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified once we release similar videos in the future. Our first valuation model is a discounted free cash flow model, where we estimate Alibaba's intrinsic value based on the present value of their estimated future cash flows. We can see here the free cash flow that Alibaba generated over the last 10 years, growing at an average 32.6% per year. Analysts are estimating future growth of only 1.5%, which I personally think is super low and maybe even a bit unreasonable given the company's track record. However, as you all know, I like to be conservative, so let's just go with it and see what we get. Using an 8% discount rate, which is also our desired rate of return, We get the present value of all future free cash flows as well as our terminal value. Adding them together plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company in 10 years. Dividing the enterprise value by the total shares outstanding, we get a fair value of $184 per share, which is over double Alibaba's current stock price of $74, indicating significant undervaluation. The second method is the multiples valuation model, where we obtain Alibaba's fair value based on the multiples of its competitors on companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying by Alibaba's current earnings per share to get our fair value, which is $247 per share. The third method is the dividend discount model, where we estimate Alibaba's fair value based on the present value of future dividend payments, specifically used for dividend-paying stocks. Now, given that Alibaba just started paying a dividend, we don't actually have enough data to use this model to value the company. We'll need at least a couple of years more of dividend payments to be able to estimate Alibaba's fair value using this model, so we'll skip it for now. The last method that we will review today is the historical multiples valuation model, where we estimate Alibaba's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we generally use 5, 10, and 20 years normal PEs. However, Alibaba only started trading on the New York Stock Exchange in 2014, so we only have data for the 5 and 10 years normal PEs. As we can see here, the Alibaba stock was trading at an average 20.65 PE during the last 5 years and 27.26 in the last 10 years. We calculate their average and multiply it by Alibaba's current earnings per share to get our fair value of $171 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models. The intrinsic value we get is $201 per share, which is almost 3 times the stock's current price and higher than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $181. So, you might be wondering, what is the ideal margin of safety? Well, the short answer is, it depends. You must consider the risks associated with the industry or the sector that your company operates in, as well as your risk tolerance, to determine a reasonable margin of safety. To help with that, let's discuss some risks associated with Alibaba and its future. I believe the main risks are geopolitical rather than company-specific. Every day now, we see negative news related to China. Beijing's relationship with Washington has been deteriorating further, and the impact on China's economy and financial markets has become more evident this year. This past summer, the White House restricted U.S. investment in Chinese companies in certain high-tech industries, such as semiconductors and quantum computing. The U.S. has also imposed export restrictions on advanced semiconductor chips that can be used to develop artificial intelligence and related manufacturing equipment, to limit their use by China's military, which could potentially impact the advancement of some of Alibaba's segments, such as cloud. Add to that the increasing tensions between China and Taiwan and the uncertainties regarding the Chinese government's crackdown on big tech, the geopolitical landscape around Alibaba does look rather gloomy and could continue to delay Alibaba's anticipated comeback. So, with all that in mind, you probably want a higher margin of safety when investing in Alibaba. For 15% margin of safety, the acceptable buy price would be $171. If you're looking for a 20% margin of safety, your buy price would be $161, which is still far away from today's price. So, without going through each and every possible margin of safety, which you can calculate yourself, let's just jump into a 60% margin of safety, which is really unheard of. With a 60% margin of safety, the acceptable buy price would be $80, which is still higher than Alibaba's current price, but less than its 52-week high. In terms of Wall Street's expectations for Alibaba stock, they are forecasting it to trade at $116 per share in 12 months, which is less than our estimated intrinsic value, but higher than the current price, implying a 57% potential upside from the current levels. Now, it's up to you to decide what would be a reasonable margin of safety based on your risk tolerance and belief in the fundamentals of the company. Personally, I believe that Alibaba is extremely undervalued at these levels and definitely worth consideration. The company has a wide moat, a remarkable balance sheet, and great financial data all around. I do own a position in the company, but unfortunately, it has surpassed the maximum allocation level that I'm comfortable with for any of my positions. So I will not be adding to my position anymore. Let me know in the comments below your thoughts about the stock. Do you agree with Wall Street's price targets and our intrinsic value? Do you believe Alibaba to be a strong buy at the current levels? Or do you believe the downside risks outweigh the potential upside return? And if you would like to learn more about other attractive opportunities in the current market, make sure to watch the next videos in which we analyze other undervalued stocks with great potential upside and over 90 years of uninterrupted dividend payments. With that being said, don't forget to like and subscribe, and I'll see you in the next video.